Okay, so although your program says that I'm Deborah Healy, I'm not. I'm Rob Nichols, and I'm going to introduce a session which is an overview of FinTech and RegTech and central bank digital currencies. And we've got three presentations prepared by four speakers. The first is Ross Buckley, who's already been introduced, so I'm not going to introduce him again. And then his paper is joint with Anton Dindenko, who's a research fellow specialising in the area of banking and finance law, qualified lawyer in Russia with a law degree from the Russian foreign trade economy, and M.Jur and D.Phils from the University of Oxford. Also in this session, we've got my friend from Tsinghua University, Associate Professor Simin Gao. She's received her doctorate degree in law and SJD from the University of Pennsylvania Law School and was a former Russell Ackoff Fellow in Penn's Wharton School of Business. She brings interdisciplinary perspective to a wide range of emerging issues that encompass bankruptcy law, corporation law, financial law, law and economics, and comparative law. And our final panel speaker is my friend and colleague, Associate Professor Heng Wang. Heng joined UNSW in 2015. He was previously a professor at Southwest University of Political Science and Law. He headed in China a WTO law centre established by the Department of Treaty and Law, the Ministry of Commerce, and SWUPL. He's been a recipient of top research awards and several major grants, including the triennial China Outstanding Law Research Award twice, and the Outstanding Research Award in Humanities and Social Sciences. So each of our speakers has got 15 minutes. I'm going to keep them quite close to time because there wasn't a break now, and you all need coffee at some point, or at least I do. So I'll ask first Ross to speak for 15 minutes and about 5 minutes of questions.
Well, I'm going to be lazy and get Anton to do most of the work, because that's what a research fellow should do. I'm just going to sit down.
That was a quick introduction.
That was a quick introduction. I'll bob up and down and make comments when I want to.
Okay. Does this thing work?
Yes. Okay. If you point it this way.
Oh, sorry. Okay.
The button.
How do I do that?
Yeah.
Okay.
It's the button in the middle.
It's the button in the middle.
Yeah, okay.
Sorry. Yeah. And how do I go back?
Left.
No. Left is forward.
It's like the other way around.
No, that's left. That's left. And right clicks. So how do I go back? Which button?
Reverse.
How do you go back? Wait. When you it goes one way only.
Just like previous.
So there's no turning back here. So, okay. So there's no turning back. So we go only one way. Sorry you didn't have a chance to get a coffee because there won't be any pictures. There will be just text on the screen. I'm sorry about this. Ross and I have recently written a paper on the taxonomy of currencies, going all the way from cash to what we call sovereign digital currencies, and we're quite happy with the term at the time. Then we looked at the program and saw, the term that everyone seemed to be using, the central bank digital currencies. So we decided not to introduce a different term, and so we'll stick to this terminology. So the starting point for this presentation will be the idea of a national payment system, and a national payment system is something I'd like to associate with the petrol in a car. You really need it to run a car, so you need it to run a national economy, but nobody really likes to spend a lot of time at a petrol station. So payment systems are important, but they are not perfect. They have a range of limitations and that need to be addressed. So what are they? First of all, operators of payment systems generate various risks. End users routinely take counterparty risks vis-a-vis payment intermediaries, especially banks with limited redress if things go wrong. For example, deposit insurance limits are practically useless for businesses. Second, operators of the payment system require discipline, and Australian banks have been particularly naughty, which resulted in the establishment of the Royal Commission in December 2017. Third, major operators such as China's Alibaba and Tencent can be a source of systemic risk. Now, another issue is the decreasing use of cash in some countries. Not a particularly popular thing, but still, it's happening in Sweden and Norway. That's why they're thinking about central bank digital currency. So the decreasing use of cash creates a number of challenges. One is the competition problem. If there is no cash, then there is essentially not a single state-issued medium of exchange, which means that all medium of exchange used in the economy are essentially privately issued, which means that cash can no longer can serve as a restraint on the fees charged by the private payment system operators. Now, second, there will always be people who are struggling with the technology, who don't have a mobile device, and therefore, if there is no cash and only digital alternative, these people will essentially become financially excluded. And finally, there will be no safe harbor in case of a bank crisis, when people usually escape to what is considered safer option, that is cash. Now, design of a payment system generally introduces restrictions on types of monetary policy that can be implemented. An example is the so-called effective zero lower bound problem. Well, theory goes if the interest goes beyond zero, or substantially beyond zero, just incrementally, then there will be escape into cash, because this is the currency that has negative interest, that has no interest at all, which is still better than negative interest when you have to pay. And cross-border retail payments are generally slower, less transparent, and more expensive compared to domestic ones. Now, a number of jurisdictions are facing the problem of the aging infrastructure. It needs to be modernized anyway, so regulators may end up thinking, well, why not choose some new technology? Finally, cash is anonymous, can be used for criminal activities. And the same can be said about the new digital alternative currencies, or so-called cryptocurrencies, that are pseudonymous, volatile, and be unsafe for consumers, but are still attracting a lot of attention. And I'm glad we have RBA person here. What about central banks? Well, central banks have routinely been tasked with addressing these issues and running the payment system. On the screen, you can see a number of citations from the different central bank mandates. The Treaty on the Functioning of the European Union tasks the European system of central banks with promoting the smooth operation of payment systems. Russian central bank law mandates ensuring stability and development of the national payment system. And the Reserve Bank Act in Australia makes sure that the Payment System Board is promoting the efficiency of the payment system and promoting competition in the market for payment services. But this is not really the end of it. Central banks' mandates are much broader than this. Just looking back at the Treaty on the Functioning of the European Union, the ESCB must implement the monetary policy of the Union. The Russian Central Bank needs to protect and ensure the stability of the domestic currency and strengthen the banking system on the whole. And the Reserve Bank of Australia, by the Payment Systems Board, needs to control the risks of the financial system in general. So where does this new central bank digital currency into play? Well, first of all, and we've already discussed it in the first session a little bit, the key difference is who is the issuer. I think what's illustrative here is the 5th Anti-Money Laundering Directive in the EU, which really highlights the central feature. Is under the directive, the virtual currencies, which is alternative to existing media of exchange, are means of exchange that are not issued or guaranteed by a central bank. In contrast, a CBDC is issued or guaranteed by a central bank. And there are several definitions provided by a number of regulators and researchers working for those regulators. The Bank of Canada, for example, states that the CBDC is basically monetary value stored electronically that represents liability of the central bank. It can be used to make payments. The Bank of England says basically the same and stresses that by CBDC one gets access to the balance sheet of a central bank. And perhaps most usefully, the Bank for International Settlements in its paper clarifies that basically a CBDC is a digital form of central bank money that is different from balance in traditional reserve and settlement accounts. Obviously, the term is not perfect because there is another form of central bank digital currency, central bank accounts that are just not open for everyone. Now, there are 4 different general options for setting up a CBDC. The first one is the direct central bank accounts. Now, back in the 1980s, the idea that a central bank could service an entire economy seemed perhaps unrealistic. It's evident from some of the papers. But in its recent report, Bank for International Settlements states, and I quote, "The technology to do so is arguably currently available." The second option is intermediated central bank accounts. That is, accounts with institutions that are fully guaranteed compared to commercial bank accounts with limited deposit insurance caps. The third option is digital tokens that represent rights to fiat currency held with the central bank. So that is fully collateralized accounts, digital units. And the fourth option is native digital tokens that themselves have the status of official currency. Now, in theory, and we're talking about mostly theory here, introduction of a CBDC can have a number of potential benefits. Now, first of all, it provides an alternative medium of exchange and store of value that is issued directly by the central bank. So, in essence, it could be a safer official alternative to privately issued cryptocurrencies that are attracting so much attention and maybe overly volatile. It could be alternative to cash in countries with declining use of banknotes and coins. It could offer greater resilience for the payment system by reducing concentration of liquidity and credit risk in commercial banks, although obviously one needs to counterbalance this with the benefits resulting from network effects and economies of scale. It could, if designed appropriately, remove the central point of failure in case of some decentralized token-based systems. It could technically improve the technical efficiency of the settlement system by providing so-called atomic DVP, that is software settlement system that cannot be divided into 2 matching transactions. So it means that either both transactions are performed simultaneously or none at all. It could offer better monitoring or supervision capabilities for the regulators, especially if it's account-based. And it could allow more diverse monetary policies, such as negative interest rates, although that requires essentially basically reducing the cash circulation in the economy drastically. And it could offer better pass-through of monetary policy by regulators, so that commercial banks will find it harder not to adjust their fees, interest rates, once the central bank changes its own level of interest payable on the CBDC. There are other possible benefits, such as increased level of financial inclusion or creating a platform for future innovation. But the ability of a CBDC to deliver the benefits is essentially based on CBDC design. And there are lots of questions that we need to answer when we're trying to come up with a solution. So first, is it going to be a wholesale or retail CBDC? When I say wholesale central bank digital currency, I basically mean settlement account money that can be used for clearing settlement of high value interbank transactions. Basically, it could be integrated into security settlement or the Forex market. In contrast, retail CBDC is open for all users, it's generally available for the general population, but of course, since it's all digital, creation of a retail CBDC means that the same units of account, same medium of exchange can be used for a wholesale system as well. Now, the second question is token or account-based. What do we choose? This is a fundamental difference in terms of design because this really affects what we use to access the units of the currency. For token-based CBDC, verification is based on the validity of digital units and the prevention of double spending problem. For account-based systems, verification is based on identity holder of identity check of the account holder. But obviously, in the context of a CBDC, they're all digital, so the key risks will be tied to cryptography and cybersecurity. Now, the third question, what is the desired level of centralization or decentralization? We can have fully centralized systems, we can have partly decentralized systems, and we can have fully decentralized systems. And there are design options and pilots and theory proposals for all of these. Now, other questions are also obvious, like, is it going to be available 24/7? What is the level of privacy or anonymity? Is interest going to be payable or not? And will there be caps on the use of a CBDC? And one of the fundamental questions is, what is the underlying technology? Now, some of the proposals really focus on the idea of using distributed ledger technology, DLT. But in its recent paper, the Bank of England, for example, writes, we are agnostic as to the technology that underlies CBDC. Use of distributed ledger technology is not assumed. And so that's just theory. Let's look at the existing pilots for both types, wholesale and retail. I'll probably finish with this. So what about implementing the wholesale system that's used for high value settlement of interbank transactions? Well, there are several projects. Bank of Canada has just completed its most recent stage of a Project Jasper, which put both securities and cash on the same decentralized ledger by converting them into digital depository receipts, and allows selling one against another on the same system. According to the Bank of Canada, both types of DDRs were able to be redeemed immediately after the transfer because the settlements were final and irrevocable. Now, the Bank of Thailand is launching so-called Project Intanon, named after the highest mountain in the country. It's a joint exercise led by the Bank of Thailand, software developer, R3, and 8 participating banks. And we're accepting proof of concept in the first quarter 2019. The Monetary Authority of Singapore has launched a similar initiative, and interestingly, it tested 3 different platforms to provide some alternative for designing the system. But for me personally, the most interesting bit is the retail implementation of a CBDC available to anyone. And the situation with the retail CBDC is very different. On the one hand, we have lots of theoretical proposals, lots of theoretical research by most of the key central banks in the world. On the other hand, there are several examples of practical implementation of a retail CBDC in several upper middle income countries. So Ecuador provides arguably, or should I say provided, arguably the first attempt to design a retail CBDC, so-called Dinero Electronico, essentially an e-money platform like M-Pesa in Kenya, but run by a central bank. Unfortunately, it generated so little demand that it had to be shut down earlier this year. But this outcome can in part be attributed to the fact that Ecuador, as a sovereign serial default, in 2015 it serviced its first sovereign bond to maturity, after defaulting so many times in the past. Now, the second example comes from Venezuela with its Petro, launched in February 2018. It was sold in an ICO and utilizing blockchain. According to the white paper, it will be accepted as payment for payment of national taxes. However, the problem again is with the national economy. It was launched amid hyperinflation and is seen widely as an instrument for circumventing US sanctions. And the third example is the Marshall Islands, where we have issuance of the Sovereign Currency Act 2018. And I quote, "The purpose of this act is to declare and issue a digital decentralized currency based on blockchain technology as legal tender of the Republic of Marshall Islands." Well, it hasn't been issued yet, but like the Petro, based on blockchain, distributed in an ICO. The trick is its development. It's developed by a third party at its own expense, but the problem is payment for these services. The initial supply is 24 million units, but 50% of that of the whole supply, 12 million units, go to the software developer, the Israeli firm. And that number is fixed in a statute. You can't really go further than that. So, okay, and so we finish.
So Ed, if the RBA ever wants to introduce one, Anton and I will do it for slightly less than 1% of Australia's total money, okay?
I'll communicate that to the board.
Thank you.
Okay, so there's a point in it. Okay, good. And I'm wrapping up with quickly looking at some of the major challenges. Well, first major challenge, we're talking about projects in early stages. Even banks, in the central banks that have run their several iterations of their national pilots, conclude that they were not sufficiently broad to determine whether DLT would yield significant cost savings or efficiency gains. The second issue is the changing role of central bank. Are we going, if we're talking about generally available central bank accounts, then does it mean that the central bank will have to be more involved in the operation of a payment system, doing the KYC, AML, CFT checks, providing information to other regulators, responding to customer queries, and all sorts of things? On the other hand, the Monetary Authority of Singapore is saying that, on the other hand, if we have a decentralized settlement system, that it means that the standard role of the central operator of the payment system will be obsolete. So we're talking about changing role of the central bank as maybe as an overseer of the algorithms that are used in the platform, settling disputes. Another angle is a competition. Obviously, introduction of a CBDC makes life commercial banks significantly harder. We're talking about competition with central counterparties that might be obsolete as well. And finally, competition with the existing forms of fiat currency. If for current end users, using fiat currency, using cash, is free, if we're talking about cash only. So if we're talking about a CBDC and the customer has to pay for using this digital unit, then there needs to be some good reason to do so, because using cash is currently free. And finally, sovereignty issues, economic sovereignty. We're talking about the Marshall Islands, technological sovereignty, the black box problem. The regulators might get some kind of software they may not understand. So do they have the ability to decipher and to find the black boxes? And there are lots of potential implications for the monetary policy, such as increased demand for government securities in case very, very high demand for CBDC, and if there are none, then we have an issue. Then maybe central banks will have to create the balance sheet out of something else. Narrow banking problem, so banks could become safer on the one hand. On the other hand, they might might want to engage in risky operations like risky lending to keep their profits, and seniorage shift to keep their. And so, to conclude, central bank digital currency projects are still largely theoretical. There is a number of pilots, both in wholesale and retail, but benefits are not clear. Ex-ante existing pilots are made limited in scope for wholesale, and for retail, examples I've given, there's so many macroeconomic implications that's not really illustrative as well. And whichever option is chosen by the central banks, I think cyber risks are going to be the prevalent thing to think about. And as Ross explained, what the two of us are really fearing is the opportunity for what we call a sovereign digital currency, or CBDC battle royale. So if a major economy launches a decentralized, uncontrollable by their state, retail CBDC that does not include KYC checks, anyone can use it, then there's real potential that it will be the dominant medium of exchange in international transactions. So how do you react to it as a regulator, and possibly by introducing your own version of a CBDC? Thank you.
Thank you both. We've got time for one question.
Thank you.
And Hen's hand is up first.
Well, thank you so much for the great talk. I just wondering, could you elaborate, I'm interested in the CBDC's impacts on the trade and investment, and whether views are cross-border. So is it possible to elaborate your view, or do you see any issues that may arise out of that?
Well, it really depends on design. Once again, if it's a wholesale system, it's usually domestic only. So we're talking about replacing so basically using RTGS system, but based on a decentralized platform, on a DLT platform. So that's not probably an issue. But if we're talking about retail, generally available system, that really is a problem of identification. So the key design choice here is it going to be cache-like, or is it going to require some kind of identification of end users and then limiting its user base? So if it's retail, similar to what we have in Bitcoin right now, when you can have an address and control it via the combination of a public and private key, you know your private key, so you control the node, you control the data on it, so you control the unit. And if anyone can control this unit, then it doesn't matter who you are. You can be a national of the country, you can be a foreign national, you can be a foreign sovereign, you can be a foreign central bank. So if we have a retail system, if it's decentralized, if it does require KYC ML checks, if it's cache-like, which doesn't seem to be the prevalent choice among the papers the central banks are writing about, but this is a valid option, then we can have this medium of exchange that's essentially available to anyone. And essentially controlled by a central bank of one country, but available to anyone, and therefore the implication is, anyone can use it, and therefore for international transactions could be cheap. If we're talking about a major economy one, we can be talking about the US, but that's probably too far-fetched because there's so many dollarized economies, so much cash circulating around the world. We're talking about
The US is still using checks. So
yeah, that's when.
Such a time warp.
Yeah, they're not even thinking about it.
But Heng, your question is probably a second stage question. The first stage will almost certainly, I think, be a wholesale a thing that's designed for wholesale and limited to domestic use. And so, in other words, institutions settling with themselves in an economy. The risk is if, for as long as Ecuador and Venezuela and the Marshall Islands are doing it, it's not going to have any international appeal, right? But the question is if a credible place does it, and if they move to the second stage, which might be either retail or beyond their own boundaries. And the space I'm watching with interest is China, because I think there's probably no government in the world with more appetite to understand what its own people is spending money on in a real-time sense than the Chinese government. I think the Chinese government would love to be able to look and see that like micro level. So a real-time system in China that gave the Chinese government more information than they're getting today might be attractive.
Okay, thanks again for both of you for this presentation.